What's up everybody, Gen X Dividend Investor here. In this frequently requested video, I tell you what dividend stocks I'd invest in today if I were in my 20s or 30s. So if you appreciate when I do videos that you guys ask for, then do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell icon so you're notified when I post new videos. And before we jump into things, I wanted to mention that my Seeking Alpha referral link in the description of this video has a special 1-year sign-up offer of $99, as opposed to the $239 that it normally is, and that promotional offer ends in 2 days on Monday, May 22nd, 2023, so I encourage you to sign up now. Anyways, let's jump into this video. You can skip ahead to the timestamp on screen, where I start talking about specific stocks, but I recommend you watch this small intro section to help make sense of things. Okay, let me first show you the demographics of my YouTube channel, which will help explain why I'm doing this video. In the upper right of the screenshot, it shows you how I created my Gen X Google account on July of 2019, and I posted my first video in August of 2019, which means that I'm only a couple months away from having my 4-year YouTube anniversary, so thank you for watching my videos and sticking with me. I really appreciate it. And here's a breakdown of my viewers by age and sex. What we see on this chart is that about 95% of my video views are by males and 5% are by females. Views are just when someone intentionally watches at least 30 seconds of a video. You can also see that the largest group of viewers are men aged 25 to 34, followed by men aged 35 to 44. So since those age ranges watches me the most, I also tend to get most requests from those folks, which is how I ended up doing this video. Now, everyone's situation is unique when it comes to investing, so in this case I'll assume I'm someone who's paid off their bad debt and they've got some level of an emergency fund and have investable cash from a job. The first thing I'd decide is if I wanted to go the probably safer and easier route of investing in inexpensive broad market ETFs like VTI or VU, knowing that historically that has been one of the best ways to make long-term gains. A downside of going with those ETFs is that your yield will suck. But if I were a young person with a job, then I probably wouldn't be looking for yield now and instead just would want to grow my portfolio size. Or if I did want some income now, then I'd go with SCHD, which I think long term will do quite well, both from an income perspective and a growth perspective. Also realize that if you're holding SCHD in a taxable account and you have job income, then you may have some taxes on your dividends, but that might be worth it for you for having more income right now. Some people want to get their dividend income flowing even at a young age to start helping pay their bills as well as act as a bit of a security blanket in case they lose their job. It probably won't cover all your expenses, but anything helps. Now, I'm sure someone will leave me a comment telling me how SCHD has sucked this last year, and my response is not to tunnel vision on 12 months and instead look over longer time frames. Yes, there can be times when a short time frame is indicative of issues, but with something like SCHD, I would recommend to look at 5 years or more. Okay, and while a guideline of mine is to limit a stock ticker to be only up to 10% of my portfolio, for ETFs I'm fine to hold a larger percentage. By the way, I did an entire video on why SCHD is my favorite dividend ETF, though it has some cons to be aware of. Speaking of cons, one potential con right now is that the overall market is currently overpriced, at least relative to some historical trends. Like, here's a PE spreadsheet I put together of the S&P 500 from the 1800s until now. The average PE over the last 150 years is 16, but the average PE over the last 10 years is a 23, and over the last 5 years is a 25, i.e. things have been overpriced for a while now, at least relative to norms. The Wall Street Journal says that as of May we are around an 18 PE. Anyways, given those data points, you need to decide if you wanted to wait until the overall market was cheaper before you invested, or if you were okay just dollar cost averaging in. For me personally, I'm fine to DCA into ETFs, whereas I like to wait to invest in single stocks until they are reasonably priced or cheap. And when I say reasonably priced, what I mean is that I like to do a discounted cash flow analysis on a stock to determine how it's priced relative to what I calculate it's worth. If you've never done a DCF before, then I recommend you watch some of Jimmy's videos on Learn to Invest, where he walks you through the process. DCFs are a way to estimate how much a stock should be priced today, based on projections of how much money you estimate that it will generate in the future. You can also look at some stock PE trends over time, and factor that into identifying when things are spendy or expensive. Not all stocks make sense for PE trends, like REITs don't. The Buffetts of the world would say that you should wait until a stock is 15 to 20% under their fair price before you buy, but that could also mean that you have to have the patience to wait a decade or more to get that awesome deal. Or you could just keep dollar cost averaging into individual stocks regardless of price, knowing that it's not ideal but at least you're investing in assets rather than wasting the money on things you don't really need. Okay, now let's talk about your portfolio. I'd recommend identifying 20 to 30 individual stocks as a guideline for how many you want. I'd also recommend that you invest in stocks across all 11 sectors. Perhaps pick 2 good stocks in each sector, and you can watch my other videos on how I like to analyze stocks. The first sector I'll talk about is energy, and my 2 favorite energy stocks are ExxonMobil and Chevron, both of which I'm long in, and both of which are Dividend Aristocrats. You'll notice that one thing I like in my companies is to have many consecutive years of dividend increases. Now, I think a reasonable argument could be made to avoid oil stocks if you're young, because I doubt the multi-decade growth returns will be there compared to many other industries. But then again, oil will probably still be going strong until the day I die. Oil has historically been quite cyclical, and it's common to see prices oscillate up and down based on a slew of factors, and I continue to stay long in it, and I think if you wanted to hold it more for income than growth, then that might make more sense. I'd personally be fine buying Exxon under 120, and it's currently around 105 right now, which means I think it has room to run still. Chevron I'd like to see under 175. Now, in terms of how much of each stock to hold in your portfolio, well, another guideline I'd recommend is to simply follow the weighting of the sectors in VTI. Like, the market cap of energy companies is 4.7% of all US public companies, so I'd have my energy stocks total up to about 5% of my portfolio, maybe 2.5% Exxon and 2.5% Chevron, or something in that ballpark. And again, you could choose to DCA in immediately, or DCA in when they're cheap or whenever you're comfortable with it. In my technology sector, I'd go with Apple and Microsoft at about 27% of my portfolio. And it's okay to let your preferences influence what you invest in, though definitely research the companies and make sure their financial trends are growing in the right directions and you believe in their futures. As long as you're going after a diverse basket of quality companies, then in the long run I think you'll be happy with where you'll end up. Microsoft is probably my favorite company, but I think it's way overpriced, and I personally wouldn't be buying over $220 or so. But hey, maybe all this AI stuff will play out more than expected, and they'll just keep trending up. Apple is another hard one to price, and I'd like to see something like $150, but I'd be okay to dip my toes in even at these prices. Apple's currently the largest position in my portfolio, because they've had such amazing growth. Other tech companies that are worth considering include Nvidia and Visa, though Nvidia is way overpriced based on my calculations. A good starting spot to identify dividend stocks are by looking at the Dividend Aristocrat and King lists. Like, if you look there for tech companies, you'd find that ADP is one to evaluate, and it's getting into a more interesting pricing spot lately. Note there are some aristocrats I don't like, so always deep dive into your own potential investments. Moving on to consumer discretionary, some of my favorite stocks I'd consider adding to my portfolio include McDonald's, Starbucks, and Home Depot, all of which I'm long in. McDonald's is way overpriced right now, and I'd rather see it in the low 200s. Home Depot and Starbucks aren't cheap, but are better priced than McDonald's at least. Other quality companies in this sector to consider include Lowe's and Genuine Parts Company. If you aren't sure what sector a company is in, I recommend using Seeking Alpha, as it usually has the most accurate info out there and is frequently a one-stop shop of having the data you need. It's not perfect, and no site is, but I like it. So like, if you googled GPC Seeking Alpha, you'd land on this page that tells you a bunch of information about GPC, like stock performance, EPS, PE, yield, etc. And if you scroll down a bit, you'd find a company profile telling you about GPC, and you'd find the info we were looking for, which is the sector they're in, which is consumer discretionary. After consumer discretionary is the healthcare sector, and some of my favorites include J&J, AbbVie, and Pfizer, all of which I'm long in, but I also like Abbott Laboratories, Becton Dickinson, and Cardinal Health. I'd pick 2 from that list and then move on. J&J looks like a reasonable price, and it's been pushed down due to some talc lawsuits along with some ambiguity due to the Kenvue spinoff. AbbVie seems decently priced right now, but it's kinda hard to calculate given all the Humira stuff. Pfizer is also reasonably priced right now, though it's definitely been a crappy year given pandemic changes. Moving on to industrials, a sector which I'm currently light in but plan to add more in the future, I like Union Pacific, Caterpillar, which I'm long in and I feel is currently decently priced, and I'd like to invest in Lockheed Martin or Northrop Grumman, both of which are too expensive right now. Other industrials to consider include Illinois Toolworks, which is currently expensive, and Emerson Electric, which is nearing a reasonable price. Moving into the financial stocks, I like Goldman Sachs, which I'm long in, and I like JP Morgan Chase, but also like Visa, which I listed in the tech sector, and I like S&P Global, Aflac, and Travelers Insurance, which I'm long in. I also dig most Canadian banks, and am long Toronto Dominion, but realize that if you don't hold them in retirement accounts, that you may have to deal with withholding taxes. Now, most bank stocks are riskier these days given everything going on, but that's also a potential opportunity. I calculate that both the GS and JPM are cheap right now, S&P Global is expensive, and Aflac and Travelers are about appropriately priced. Then we come to consumer staples, and favorites I'm long in include Pepsi and Procter & Gamble, both of which I calculate are expensive. And I also like Coca-Cola, Kimberly-Clark, and Colgate-Palmolive, all of which I calculate are expensive. Others to consider include Target, Walmart, Costco, and Clorox, all of which look expensive to me right now. In utilities, my favorites are Duke Energy, which I calculate is appropriately priced, and Southern Company, which is expensive, both of which I'm long in. I also like Nextera Energy and Con Ed, both of which I calculate are expensive right now. Next is real estate, and my favorite is Realty Income, ticker O, and I also like National Retail Properties, ticker NNN, both of which I calculate are appropriately priced right now. The interest rates in the overall economy have kind of pushed those down a bit. Other REITs to consider are WP Carey, ticker WPC, and Vici, ticker VICI, which focuses on casinos. But since Vici's only been paying dividends for 5 consecutive years, it doesn't have enough of a long track record for my personal tastes. Next up is Telecom, which I currently don't have a position in, but both AT&T and Verizon are worth considering. And if you look at sector weighting, you'll see that telecommunications is only about 2.3% of VTI, so you don't have to hold any telecom stocks if you don't want, but putting 1% in 2 different stocks could also work. Finally, the last sector is basic materials, which is another sector I'm personally lacking, but there are lots of decent stocks to consider, including Air Products and Chemicals and PPG Industries, both of which I calculate are expensive right now. One thing to try to do is avoid having stocks in the same industry, if possible. Now, while I open and set out to invest in those stocks in my 20s or 30s, the reality is that I'd invest in them at pretty much any age, assuming your goal was long-term investing. Higher yield stocks, like the telecom ones, tend to have less growth, but using them to enhance your yield a bit in the interim might make sense for you, if that's what you want. Or you could avoid them, as that would be fine too. But such a small percentage wouldn't materially change things regardless. And if I needed more income now, then I'd shy away from lower yielding stuff in favor of higher yielding stuff, and I could always look at things like Altria, British American Tobacco, Enterprise Product Partners, and maybe a covered call ETF like Devo. Anyways, hopefully now you have a good sense of what stocks and how I'd craft a dividend portfolio if I were trying to do that. And with that, I'd like to close things out with a shout out to Chimney NYC, who snagged the Patreon Aristocrat slot, and note I'm currently sold out of any more Aristocrat or King seats. Aristocrats get access to my Dividend spreadsheet product that I use in my videos, and they get to be in multiple private channels on my Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them publicly on YouTube, as well as let them vote on which thumbnails I use for my videos, and of course they get more direct access to me. I also do a shout out as you just heard, and I add them to my scrolling news sticker if I still have space on it. And as I stated in the beginning of this video, don't forget to check out my Seeking Alpha affiliate link in the description of this video before they raise prices. Finally, if you made it this far in the video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Plus, I urge everyone to join my free Dividend Discord chat server, which has over 10,000 Dividend investors on it from over 72 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.